Welcome to OpenECRI's Trader Training. My name is Toby Gennaro. What I'll be talking about today is the importance of reward to risk trading and how it can help your trading consistency over the long haul. Let's take a look. As traders, we are constantly exposing ourselves to manageable risk, and that is the risk of losing our capital. And we have to accept this as traders. It's just part of the deal, part and parcel of the reward. And we continue to do this because there's a payoff that is potentially greater than the risk that we're taking. So we risk our capital for the potential to make the same or more than what we risk, and that is the reward for assuming the risk. Now, many folks who trade the markets miss this concept. Risk is an extremely important part of trading. It's important because it's the one thing in trading that truly is manageable. If you're constantly taking unlimited risks in the market for limited profits, that's just not a good business scenario. There are two main areas of risk. What is the account risk and what is the trade risk? One of these is fixed and the other is variable. For your account risk, this will be a percentage of your total account value. At Trade with Precision, our standard is a maximum of 1% account risk on every trade. For example, how much of your account are you willing to risk on one single trade? In this example, if you have a $15,000 account, then your maximum loss on any one trade would be $150. Now, most people in the markets want to make $15,000, not just $150. They want to double their account size next week. Well, don't we all? Money management is the most important skill when trading the markets. If you manage your money loosely, it doesn't matter if you make $15,000 next week, and the week after that, and the week after that. At some point, you're going to lose it because your risk scenario is unlimited. So think of it this way. If you could find just one trade every 2 weeks that would earn 1%, that's an annual return of 25%. That's not a bad return at all. Now, 25% on $15,000 is not going to be much the first year, but consider this. Warren Buffett has averaged 25% over his lifetime as an investor. That's about 60 years. And Mr. Buffett's one of the richest men in the world doing 25% annually. So professional traders are not risking everything to make a return. They focus on how much to risk first and then being a good trader second. Now, trade risk is different because this is the amount of pips, ticks, or points you risk on a trade. And this risk is defined by your entry and your stop loss. And since we typically trade different time frames, this risk will vary from trade to trade. You can't expect to have the same stop loss for every single trade. But you can manage the amount of shares or contracts you trade to accommodate your 1% account maximum relative to the pips, ticks, or points risk for a specific trade. So if you're going to manage risk, then where do you place your stop? Since you have to play good defense in the markets, it's smart to define technical stop locations. This will ensure correct trade management practices in your trading. Now, there are various places to put your stop loss, but one of the best is always where price is telling you to put it. So you have to ask yourself the question, if I'm wrong on this trade, where will I be wrong? If I thought this was an uptrend, where will it change to a downtrend? This is where you want your stop placement to be. And this is always known before you enter the trade. When you understand trends well enough, the chart will tell you it's very objective. There's no guesswork here. You should avoid placing stops at a set number of points away. This is random and is not based on any current price action. So with any trade, we're always first looking at our total risk on the trade based upon our stop and our entry. And then we decide how many contracts or shares to trade to stay within our 1% account maximum. Managing your trade risk is one of the most important things you can do within your overall trading strategy. If you're interested in improving your trading, check out the OpenECRI website under Education and look for other trading videos and webinars, or you can call customer service for more information and educational events. Thanks for watching OpenECRI's Trading Education.